Hi there, I'm James Osborne, the co-founder of the Recruitment Network, and this is the TRN Podcast. Every week, we unpack the strategies, the technologies, the processes and mindsets fueling today's top-performing recruitment agencies. We take a look behind the scenes of some great recruitment businesses. We listen to the real-life stories of those who have built those businesses, and we learn from some of the industry's greatest thought leaders to help you become both future fit and future relevant. So let's begin with this next episode of the TRN Podcast. Bilal Khan. From Grant Thornton. Thank you for coming on today. We're doing this series at the moment all about understanding what the hell's going on in the recruitment sector. Understanding where the sector's going, or not understanding, I don't think anyone can understand it, but just trying to be able to predict a little bit better about
it's a bit of a changing landscape, isn't it? So which way is it going? And
I mean, it's continuously changing, right? I mean, it's just unbelievable. So we brought you in because obviously you've got a very different angle from some of the other people we've interviewed. Obviously, you're not a recruiter, I don't think. Have you ever been a recruiter?
No, I haven't. I haven't.
Ever wanted to?
No. Well, when I worked with my first recruitment business and I kind of saw some of the commissions that people were getting, I was thinking maybe I should.
Changed my mind pretty quick. Exactly. So just give us your background then of what you did, how you got into industry, and where you're at the moment.
Perfect. So as you said, look, Bilal Khan, I'm a director at Grant Thornton. I work within the M&A team in London. Been doing M&A for about 10 years now with Grant Thornton, and we're very sector focused in our team, and my specific kind of sector focus is human capital and recruitment. So I've been doing kind of recruitment deals for the last 10 years, working with founders, owners, kind of management teams in supporting them to grow their business and then really kind of realize value. And that's predominantly selling either to a private equity buyer or selling to a larger trade buyer, and kind of got experience with selling to both in the UK and internationally as well. And interestingly, I guess working with buyers as well as to what do they look for when they're acquiring a recruitment business. What are the kind of value drivers? What are the risks? And what are the kind of key diligence areas that they'd be interested in? So seen it from both sides really, the sellers and the buyers, and been doing that for the last 10 years or so. And you talk about HR and recruitment, because that's always separated, right? We also talk about HR and recruitment. So are most of your deals within the recruitment sector or on the HR side? Or is it HR tech? I'd say it's mostly in the recruitment side, but I'd split that between, you've got exec search, you've got interim, and then you've got kind of like the perm recruitment as well. So across those kind of areas of the market. So I look at what you do as I look at the recruitment sector as a really interesting barometer of what's the economy is doing. Because when obviously when the recruitment does that, the economy's probably got to do that next, sort of thing, which is always good. I look at what you do as probably a barometer to the recruitment sector, because you're dealing with the people who are investing in the recruitment companies to allow them to be able to do that. When you look back let's go back over I don't go back too far, but let's go back over the last 5 years. Just sort of almost like paint the story of the pre-COVID to today, and we're going to look at tomorrow next, but the pre-COVID to today journey for investment in the recruitment sector. So recruitment has always, rightly or wrongly, kind of perceived as a bit of a cyclical sector for investors. So pre-COVID, you had investors that kind of liked the sector and did deals in the sector, or you had others that just wouldn't come close to it, so wouldn't really do deals. And then you've got the trade guys who, if it's the right business, right time, would be interested. What happened, I guess, during COVID, everything went on pause, not just for recruitment, but for the M&A market as a whole, right? Everything kind of stopped.
Which must have been really tough for you guys.
From a GT perspective.
What did you do?
It was. So interesting you asked that, actually. So for like 6 months, I actually moved over to our restructuring team.
Right, okay.
So I worked in our restructuring team for 6 months and worked on kind of administrations and did that. And internally, those people that we could kind of move around, we did, and those that didn't move around, we kind of supported clients with CBILs at the time, refinancing, with conversations with the banks. So the clients that were kind of struggling, what can we do to help? What relationships do we have with your lender, for example, to try and negotiate a bit of a holiday or negotiate something else that kind of support you through that period. But deals just stopped across the board, so that was a bit of an inertia period for a little while, but then once people realized this is almost like the new norm, and deals did start happening again. And it was interesting because we did a couple of deals which were just completely remote, where you didn't meet the client face to face, you didn't meet the buyer face to face, you just did it all over Teams and DocuSign, and that's me kind of
brilliant.
Usually have a completion and everyone's kind of crowded around the lawyer's office. You've got loads of paper on the table, but we did it all through DocuSign without actually meeting the client.
Virtual glass of champagne.
Yeah, exactly.
Wow,
exactly.
Extraordinary. Okay.
Yeah. And then I guess following that bit of period of inertia, I guess the economy came back quite strongly, and there was a lot of kind of growth and activity again, and a lot of recruitment businesses kind of started flying, record quarter after record quarter. I'm probably thinking 2021, 2022, and there was actually quite a lot of activity in the sector from an M&A perspective. We were really busy from a GT perspective, did kind of numerous deals over those couple of years. There were pent-up demand because of that COVID slowdown, and then it was just the market was doing really well. And as you've said, if kind of recruitment's going like that, the economy's going like that, and it was a bit of a frenzy. I guess following that period of heightened deal activity, I think the last couple of years, as you know, have been tougher. The market's kind of slowed. We had Liz Truss and her kind of mini budget. We had inflation going a bit out of control. We had interest rates rising quite significantly as well. And people kind of thinking, okay, what does that mean for the economy? And if that's a bit more of a flat economy or a declining economy, then what does that mean for recruitment businesses? And you can even look at the large listed ones that are all kind of going backwards and struggling a bit. So over the last couple of years, it hasn't been as busy from an M&A perspective. Deals are still happening, but they're happening in very specific niche sectors. So a couple of the recent deals that I've kind of been involved in education recruitment, seen as more resilient, not kind of cyclical, private equity focused businesses that are working with private equity clients and placing clients within portfolio companies. That's seen as a bit more resilient as well, and a bit of a focus area for larger recruitment businesses.
When you, and I'm definitely not going to ask you to name any names here, that just wouldn't be totally unprofessional, but when you look at some of the businesses that you've advised in that post-COVID boom, presumably some of them haven't done as well since necessarily, sort of stuff. No. Is that what's the repercussion of that? Is there any repercussion for that from your point of view, or have you done your bit? I'm not giving you a hard time here, by the way, but I'm always finding it fascinating because you're in that post-COVID boom, which is a little bit of a false economy to an extent. Big bubble. Everyone invests, puts their money in, then suddenly you go, oh, hang on, I've just bought something, maybe I didn't need it or didn't want it necessarily. I'm not saying that's the case, but that must be challenging to see that a little bit. So.
Yeah, it definitely is. And it's something you never want to see, right? Like these clients we work with, you can work with them for like a year or a number of years. So you can really build a close relationship with them, and you stay in touch with all of them, kind of post-deal as well, as to how is the new life and what's happening. And if they're under a lot of pressure, then it's not a nice place for anyone to be in. And typically with, I guess, recruitment business, you may have like an earn-out period. So there's discussions around, look, how can I meet my earn-out? How can I get the rest of this and the proceeds at part of the deal? So it is difficult. And if the business is kind of leveraged as part of that deal, and you've got a private equity investor with leverage, you can get into kind of hot or a bit of trouble under those circumstances where the PE house starts to make change if the business isn't performing and isn't doing what they thought it'd be doing.
And presumably now, though, after that period, there's a bit of pepped up cash. There's probably a pepped up. I mean, those, if you've got a trade organisation that's backed by PE, they're being pushed now to go and spend some money.
I think definitely that the interest in the sector is coming back, and what kind of, I guess, disrupted the market before in terms of interest rates and inflation, all that kind of that's kind of under control again. Inflation is around the 2-3%. I know it's gone up a bit in the UK just the other day, but interest rates are down again. They're not at those 5-6% levels again. So there is that normality returning to the broader macroeconomic environment, and that should then spur more activity, and there is pent-up demand. I guess the most recent shock we've had is Trump and the tariffs and the impact that's going to have, and a bit more of, are people going to sit on their hands again, or are they going to make recruitment decisions?
But even that seems to sort itself out a little bit. I mean, that's everyone uses the classic Trump thing: make a massive statement and then retract it slowly so you have a good guy, basically. But
and if you look at the world stock markets, right, the FTSE's kind of back, I think, even higher than where it started pre kind of Trump, and the S&P 500, the kind of US metric is pretty much there, back to where it was. So there's a bit of a dip and recovery. So since, over the last few months, so have you actually seen that manifest into more deals? Obviously not happening because it doesn't happen just like that, but more deals starting to go through the process. These things take a bit like 6-8 months in many cases. So so you're starting to see more activity, more generation going on at the moment. So as you said, these processes can take anywhere from 6 to kind of 12 months. But I think now kind of owners of businesses are coming back to the market and saying, actually, we've got a bit of a period of normality. Let's start prepping, and then let's go over the next kind of few months. And then buyers are coming back as well. The kind of conversations I'm having with either private equity or the larger kind of trade buyers. There is interest out there. They're looking for specific elements, kind of resilient businesses that have been able to kind of grow in this market or grow the last few years will be kind of really attractive. And otherwise kind of specialist niches. What niche are they operating in, and can they find a business that fits really nicely with their own business as well from a niche and targeting perspective.
Well, I want to explore that more with you in a second, actually, because that's obviously a real interest to anyone who runs a recruitment company. Is actually, what do I need to look like to be attractive? Not necessarily because I want to maybe do an exit, but in some cases, if I've got a valuable business that's sellable, I've probably got a bloody good business, so I might as well just keep it. In some cases, which is fine. The valuations of recruitment companies and how that presumably has changed, and obviously the PE multiples would have definitely changed and taken a bit of a hit for a period, probably coming back a little bit now, but there's a whole journey around. There's two sides to this. Number one is, has the due diligence got much tougher? So, because we often hear about people looking under the bonnet of any business and going, actually, well, that's not quite what it looks like on the outside, and let's really understand this business. So there's that side. And then the second question that I suppose linked to that is then, how's that manifested into, therefore, what people are willing to pay multiple wise?
I think the diligence has got tougher, certainly. And I think it's also not just the diligence has got tougher, but people are a bit more risk averse as well. So where you might have a bit of a red flag in the diligence due to, I don't know, consultant concentration being a typical one, high level of churn amongst consultants, or even client concentration. I think maybe a couple of years ago, during that kind of boom time, your buyer would maybe take a view on that and say, you know what, it's a bit of a risk, but the market's doing really well, we're doing really well, let's go ahead and do the deal. Whereas now it's a bit more like, well, that is a bit of a risk. Do we need to pause and have a think about if we're still going to do this deal, or do we need to pause and have a think about how we can overcome that risk before we actually do the deal? So how can we either reduce churn, or how can we get comfortable that churn's not going to be an issue? How can we kind of retain or incentivize some of these really key billers or key kind of consultants that are delivering a lot of the NFI, for example. So there is that element, and that can either, as you kind of said, go to value or go to timing. So it's going to take longer to do a deal because we need to get more comfortable with these elements, or actually, we're just going to pay a bit less because we're not too comfortable with these risks that are in the business. And I guess in terms of valuation multiples, generally within the recruitment space, I'd say historically 6 to 8 times EBITDA. If you're a very specialist business in a high growth niche and you've got some kind of international exposure as well, that's a key kind of I guess criteria for buyers is international exposure. Right, okay. Key positive. If the market's growing, then
sorry, just really quick, when you say market exposure, how do you define exposure? Is that like boots on the ground, office presence?
Not necessarily. So you could just be a UK based business, but you're doing placements out in the US, for example, or you're doing placements out in Europe. That's kind of exposure to that market, because globally, if you speak to any of the international buyers or just kind of recruiters more broadly, the UK market is seen as the most competitive, the most mature recruitment market kind of globally. So the rates are lower, it's harder to do business. So if you can crack the US market, for example, where salaries are higher, rates are higher, kind of fees are just higher, and you can make it work out there, it can turbocharge your business. And it unlocks buyers that are out in the US as well, who are headquartered in the US, both on the trade side and actually the private equity side as well. So you start bringing in new buyer pools who are interested in your business and who can typically pay a bit more as well, because the US recruitment businesses are kind of valued higher as well compared to just pure UK businesses. If you've got an office out in the US or in Europe and boots on the ground, that kind of just solidifies that exposure.
Right. Okay. And when people, this due diligence piece, when people do look underneath the bonnet, there's there's many cases have been surprises.
Yeah.
What are some of the classic mistakes a recruitment business would make? They're almost like hiding. I don't think they're hiding it. It's probably the wrong word, but they're not being really focused on what is really under the bonnet. What are some of the things that people, when they listen, go, oh, that's again that always pops up. What sort of thing we talk
so what buyers would look at, or diligence providers would look at, is we call it the 3 C's. So clients, candidates, consultants, and what risks do you have there? I'd say the typical one is churn and concentration of consultants and
of consultants.
Of consultants, yeah. So your billers within your business, maybe, I don't know, you've got 2 or 3 that are generating significantly more than
everyone
others.
else.
Then everyone else, exactly. So then the buyer's like, okay, you've got these superstars or rock stars, they're doing really well. Then you've got a long tail of mediocre people. How am I going to scale this business? How am I going to find that next kind of superstar or rock star that's going to really kind of drive performance and scale the business? Because it's really hard to do that if you just have to hire loads of people that are kind of down here rather than the ones that are up there, and that's quite hard to do because it's hard to find the really high performance in individuals.
Okay, so let's go into this multiple questioning, because it's always the question, and I've got a list of like 16 things that I talk about, whether the 16 are right or wrong, but and concentration of consultants as well, and concentration of clients, international exposure, as you talked about. What are some of the other things that probably let's fast forward now? What are some of the things that are the world looking for now, more in particular? It's like probably maybe even different from what was in the past.
Yeah, so that's a key area actually. What are you doing differently? Are you just a recruitment business doing perm placements, doing contract placements in a very people focused way, where your relationships are held with your consultants and they're finding the candidates and they're matching it all up, and it's very kind of people driven? Are you making use of AI? Seeing that much more as a question. So are you automating your processes? So can you match either your candidates to your jobs, either using AI or using a data-based approach to make the process either more efficient or kind of automate it? Are you making use of tech to be able to do that? Are you kind of giving data insights to your clients so they actually value what you're doing above your competitors? And it's not just a people-based approach, but it's, I've got all this data and all this history, which is why this candidate would actually be a really good fit for what you're looking for. And are there any other services you're offering? So we've got clients that kind of move into maybe they do training as well. Maybe they support with assessment as well. And then you start becoming a workforce solutions provider. So it's not just a recruitment business. Now we've got a multifaceted kind of talent solutions business where we support you with either training or we support you with assessment. We can do an analysis on your management team, tell you where the weaknesses are, tell you where the strengths are. And it's all from a data-based approach or a tech-based approach as well, rather than just being a recruitment business. And the acquirers like that because it makes you stickier with those customers?
Exactly. Or is it,
exactly
but is it also because you're increasing customer lifetime value, so you're getting more penetration?
So you're increasing your wallet share with your clients, and then you're becoming stickier as well. And it's almost like you're becoming stickier with a higher value piece of revenue, because the biggest risk that acquirers see in recruitment businesses, as we've kind of touched on, is the cyclicality. When the market's doing really well, we're doing really well. When the market's not, we're not, because clients kind of turn off the perm tap, for example. But if you've got other services you're still offering, that provides a bit more stability. So
it smooths out that sort of up and down.
Exactly.
Exactly. And presumably trade buyers are more understanding of the cyclical nature of recruitment, because they get it. They've done
that's the business that they live and breathe. But then also it's interesting because if the business is cyclical, your trade buyers going through that same cyclicality, so they're not necessarily ready to buy if you're going through a bit of a dip period, because they're experiencing that dip themselves, and they're maybe a bit more inward looking as to how can we trade out of this, rather than how can we go out and deploy capital. where deals do happen during those kind of really turbulent times is more on the distressed side of things. And that's where multiples really kind of come down, or it could even just be a trade in assets deal where there's no kind of value returned to shareholders, and it's just we'll pick the business up and take what we can at the time. A bit more opportunistic.
Yeah, sure. And then so if I was looking at the sort of the buyer side now, who are the ones who are really active? Is it the private equity houses? Are they getting really excited by seeing recruitment coming back again and doing its thing and this next journey we're about to go on type thing? Is it the trade buyers? Is it somebody else? What?
Yeah, so it's interesting. So I'd almost split into three kind of categories. So you've got the private equity buyers. Yeah. Recruitment has always been a bit of like Marmite for them. Yeah. You have maybe a short list of private equity that like the sector, or maybe not like, but are comfortable with the sector and will do deals in the sector. Yeah. But I'd say the majority of the private equity space are adverse to the sector due to the concentration of billers, the churn, the perceived kind of cyclicality of the sector. So I think you've got that core private equity who are comfortable with the sector, and they're there and they will do deals. I think trade are coming back more now, given the market's kind of returning. But to get that trade interest, you need that differentiation as well. Yeah. A lot of the international buyers looking at the UK, their kind of first question is, what international exposure do you have? Or are you just a UK focused business? And then you've got some consultancies who are starting to look into the sector. So Teneo, they've acquired in the space. A&M, Alvarez & Marshall, they've acquired in the space. So you've got some of those consultancies slowly moving in, but they're a bit more exec search focused and that kind of high value focus. So you've got a mix of buyers out there.
And geographically, are we seeing lots of interest from like American businesses looking into buy into the UK in particular, or is it Europe? I mean, I was chatting to someone earlier. I mean, I probably had 3 different people approach me in the last probably 48 hours actually, basically saying we're looking to buy stuff. Who do you know? Who can I introduce me to? Obviously, we've got a big network, etc.
Introduce them to me.
Well, exactly. Yeah. But this is happening quite a bit at the moment. And then we've got some of those. I've been approached a couple of times over the last 3 or 4 months from quite sizable business I didn't know existed over in the Nordics. And they seem really interested by the UK market in particular. So what's going on there? I think those ones are definitely more education, healthcare type stuff. But where are you seeing the biggest interest from an acquisition point of view?
Yeah, it's really interesting that you've kind of picked up on that, because there's some really large recruitment businesses out there who have private equity backing that are not in the UK, and they've had that backing quite recently over the last maybe 12, 18 months. So they're going on a bit of a buy and build journey. So if I think of some names off the top of my head, so you've got House of HR being one of them, World of Talents, another one in kind of Europe, and then similar thing kind of happening in the US, but they're kind of privately held or private equity held, so they're not kind of listed anywhere. And you may not have heard of them, but they've got hundreds of millions in revenue, maybe hundreds of millions of EBITDA as well. And
I did him with one very recently. I've never heard of you whatsoever. And he showed me his balance sheet. It's like, I need to hear of you. That's impressive. Really impressive.
And actually, you've got interest from Japan as well. So you've got some really large recruitment businesses out there who have been bit more focused on engineering and manufacturing, but they're looking to expand globally and kind of diversify away from that kind of local concentration in Japan. So we've had those types of businesses that look in the UK quite a bit, and we kind of speak to them quite often as well.
Yeah. So at Grant Thornton, are you seeing this? Do you feel that we're in another cycle, and we're at the start of another cycle that's going to go in a bit of a hockey shape upwards?
So I guess we've been looking at the market the last kind of maybe few months or year almost, and as things are stabilizing more from a macroeconomic perspective, as I say, kind of inflation coming down, interest rates coming down, we've had the new government come in here and in the US as well. You're almost at that period now where we've got that stability to let the market come back and come back quite strongly after those 2 maybe 3 years of post-COVID, where it's been quite challenging from a running a recruitment business perspective, growing a recruitment business, and that's kind of gone into valuation and interest as well. But we're kind of looking at where we're at the start of that kind of market coming back quite strongly.
And the shift in the UK from now 14% to 16% in disposable asset relief and entrepreneurs relief, that type of stuff, has that sped things up a little bit as well? Are people going a little bit, come on, we need to get going now?
It did at the time of coming up to the budget, but I think actually people expected a bit more of a shift and expected the rates to go higher quicker. So there were deals happening ahead of the kind of change, but I think because the uplift hasn't been as significant. I mean, there were talks of, is it going to be the same as like income tax, or is it going to get quite close to income tax, which then will it make it kind of not worthwhile doing these types of deals anymore? So that kind of doomsday scenario hasn't manifested, and I think the slightly maybe a bit more modest of an increase has got people a bit more kind of comfortable that they can kind of still kind of trade through it, and actually rather than rushing out, let's do it at the right time.
It probably has expedited it a bit, I would imagine. People do it. So
It's funny, it's a bit of a running theme over the last few years where it's a budget's coming up, so from an M&A perspective we use it as a bit of like, CGT is going up, entrepreneurs relief is going up, and everyone starts doing deals. It happened just before COVID as well, when the entrepreneurs relief changed then as well. It's been kind of, it's been in the market a few times now where it's going to change or it's going to go up, and it spurs deal activity.
Yeah. When you're going through processes with businesses, how important is sort of our cash reserves in the process? I mean, should people be sort of almost like hoarding cash now to make their balance sheet look more attractive as part of that process, or are people comfortable and almost prefer people saying, actually, you're using your cash, you're investing in it, what's the general system?
I think if you can make efficient use of your cash and invest it and do something to grow the business, then do that, and it'll be seen kind of favorably. The other side of cash is your debt side. Do you have an invoice financing facility that will come off your price? So if you're running quite a significant invoice discounting facility or other kind of means to fund your debtors, that's going to reduce your kind of final take home, because that will come off the price. So I think rather than having that cash kind of buffer there, it's a bit more have a think as to what debt do you have in the business, and are you running an invoice discounting facility, and just kind of keep in your mind, if that's running at a couple of million, you're going to lose that as part of the process.
When we look at the concentration of your products, and we've been talking a lot today around products and services of tomorrow and what people should be doing. Outside of the obvious, so contract is often favoured over perm, for obvious reasons, etc. What else are you seeing? So we're seeing a lot of growth in platform stuff. We're seeing a lot of growth in statement of work and etc. and MSP again. What are some of the things again outside of the traditional contract, perm or interim, etc. are investors really excited about or interested in?
Yeah, it's funny because I actually had a conversation with a PE investor just yesterday. He was saying he wants to bring kind of an automation approach to recruitment. So he understands it's very people focused, right? And you've either got temp or you've got perm, and you've got the benefits of either. But how can we speed up the process? How can we make the matching process more efficient? How can we make kind of going through CVs more efficient, or how can we kind of go through candidate databases more efficiently? So I think that kind of use of tech, and I know AI is a bit of a buzzword, but I think if you can make that work and really show how you're differentiated from just a people-focused business, that will get you value. And I think to go one step further is, as I said kind of earlier, what else can you offer a client outside of just the pure kind of recruitment side of things, and can you get a client paying for that additional service? I think that's the real kind of key to show you've got stickiness outside of just that.
There's more than just a transactional relationship.
Exactly.
But going back to the AI stuff, because obviously it is a big thing, and I think a lot of people are presuming now if you want to get value in your business, you've got to be an AI firm. So I'm not sure that's necessarily the case, but is it enough to rely on having a proper, strong relationship with your CRM provider? Because all these CRM providers are investing millions into the AI. They're doing all the work. As long as I've got access to, and I'm using what I'm paying for, that gives me the same thing, right? Is that enough? Or do I need to go and build some stuff?
I don't think you need to build it kind of in-house, right? And spend however much it's going to cost to do it. You can find a really kind of reputable third-party provider or your CRM provider if you're doing it. I think the key is, are you doing it? And if you've got a CRM provider, do your consultants use a CRM, or is everything kept in your Outlook or your Black Book or LinkedIn messages? Because that's one of the other areas of diligence. Even when I go into a business, we're like, let's have a look of your candidate database or your placements and all that kind of stuff. And if there's no way where someone can just download that information, because it's not kind of properly tracked on the CRM, or it's not it's just not properly kind of stored or tracked. Instead, it's in LinkedIn messages, it's in email somewhere else, and it's a bit all over the place. So I think if you are doing it, just make sure you've got the culture of doing it properly. So when someone comes in to look at your business, they have access to that information, and they can see actually, you do have a really strong CRM system. It's got built-in AI functionality, which actually the business has been using. And then can you evidence those efficiencies that it's provided you? Has it sped up your hiring process, or has it sped up your shortlist process? If you can show that, that's the real key, and say, look, a year ago it used to take us X number of days or time to get through this. We've now reduced that by, 10%, 20%, or wherever it might be, which then increases efficiencies and then hopefully increases kind of profitability of the business as well.
When people are looking at valuations of businesses, we often say to people, if you're going to go on a journey, you look back 5 years, and you need to demonstrate that you've deliberately grown to this point, and therefore your plan for the next 5 years feels comfortable. The last 5 years have been pretty bloody weird. It'd be fair to say. So I mean, there aren't many businesses, I don't think, that have traded to budget to plan over the last 3 to 5 years, and they've sort of just hustled through it and come out the other side, in some cases brilliantly, some cases not so, etc. How much, when we're going through due diligence, is there any merit in actually looking back over the last 3 to 5 years? Because it's been such a weird time in many cases.
No,
even the post-COVID boom, you look at that and go like, you were brilliant then. Well, but I mean, everyone was.
I think if you look back, maybe, and we include the current year, last 3 years of performance, and how have you done there? Because if you go back all the way to kind of COVID, you probably you did really well. You've come down a bit, and now you're starting to come back again. So if you take out some of that noise, it's almost like you've been growing maybe the last kind of 12-18 months, or you've had a bit of turbulence, but now you're growing again. And then the key is how do you continue growing? How do you take the business from where it is today to either double or triple in size? Because from an investor's perspective, private equity, just kind of rough rule of thumb, they're looking to either double their money in 3 years or triple their money in 5 years. And is your business going to allow them to do that? From the position you are today, can you double and triple in size? And how are you going to do it? If you've got, 20 consultants today, how are you going to get the next 20, or how are you going to get the next 40 to be able to deliver that that level of growth? And I guess it's almost easier to do it when you're a smaller size, when you're bringing these consultants on. But then when you need to bring them on at scale, and make them stick and keep the culture and keep the performance, that's when it gets quite a bit harder. And that's what the investor's looking for, is how do we take this business from where it is today to either double or triple in size, and have you got a blueprint to be able to do that?
Okay. I suppose there's one last question I wanted to get to, and again, going back to how we started, recruitment, I think, is a flag bearer for the economy. I think the investment market is a flag bearer for the recruitment market, which is a flag bearer for the economy. So if I was to ask you on camera now, but are you excited by the next 18 months, 2 years, 3 years ahead? And should we therefore be getting as excited now and really start thinking, it's been tough, and yes, there's volatility, and yes, who knows what Trump's going to do next, and et cetera. But actually, all the signs, irrespective to an extent of what we're reading in the papers sometimes, actually, when you go to the people on the ground who are investing in recruitment companies, who are spending money, who spent millions of pounds probably trying to analyse the data as much as anyone else has, are you as excited are you excited?
I say where we are today, look forward kind of 12, 18 months, next, 5 years. I do think it's a good place to be, and I do think I'm kind of excited from a deals perspective. We've gone through a couple of tough years, and as I kind of said, the macro kind of economic indicators are a bit more stable now. The environment's a bit more stable. Businesses are starting to kind of come back out of that kind of difficult period, and actually if you're in a very specific niche that's growing regardless, you're still considered very attractive. But then if you're maybe a bit more of a generalist, then you're coming back out of that. I do think it'll be quite an exciting time for the sector over the next few years, and there's money out there, right, to do deals, and you've got large trade buyers who are private equity backed. They need to grow. They'll do that through acquisitions and organically, but acquisitions will be a key part of that. And then you've got the private equity buyers who do like the sector, and they've got money, so they'll kind of be there to do deals as well. So hopeful for much more activity over the next couple of years.
Good, fantastic. But I really appreciate your time.
Cool. Thanks for having me.
Super. Thank you.
All right.
And that's a wrap for this episode of the TRN Podcast. Thank you for listening. And make sure you grab the free episode toolkit. All the links are in the description. And click follow in your podcast app so you can get notified of our next episode. If you want to get more out of your business and your people, then please unlock 30 days from our platform, TRN World, for free. And help yourself to all our training content, our guides, our templates, and peer insights. You can get started at trnworld.com/trial. And finally, if you found this episode of the TRN Podcast of use, please share it with your network and tag TRN on any socials with your takeaways. Otherwise, message us directly if we can help in any way. We do reply to every question. Otherwise, we'll see you next week on the next TRN Podcast.